Housing market has survived rates near 7% for a year, but that resilience is starting to crack. We see inventory rising. Sellers are cutting their prices at a very fast rate, and buyers are canceling their contracts. And now higher rates are impacting the entire economy. We're starting to see the distress come to the surface in the marketplace. So I'm going to show you what is happening. If you're a buyer or you're a seller or you're an investor, this is information you need to know of what is actually happening on the ground in the real estate market, not just what you hear from the mainstream media that is bought and paid for. So the market is starting to break. So here you can see the 10-year treasury, which has been drifting upwards since March, and it's been a massive problem for the real estate market. This is part of the reason why we're seeing pending sales hit record lows, even worse than the great financial crisis already in terms of the number of pending contracts. And this is simply a function of the market becoming so unaffordable to the regular home buyer and the sellers being stuck at their 3% mortgage rates that they don't want to give up. And it's tied to the 10-year treasury because that's the average duration that a buyer stays in their house, an owner stays in their house. And so when they sell, they pay off their mortgage. That's why mortgage rates are tied to the 10-year treasury. But we're seeing this drift upwards, and it's causing a ton of issues. Right now, the mortgage interest rates are around 6.7%. But when we look historically at the 10-year treasury, I mean, we used to have rates, the 10-year treasury at 15% back in the 1980s. And so the market has benefited from 40 years of falling interest rates, which has pushed asset prices to insane levels. Well, now it looks like we're having that reversion, right? So the prices skyrocket while rates fall for 40 years. And my question for you is today, and I'd love to hear from you down in the comments, is right now an inflection point, right? We just are crossing $40 trillion in U.S. government debt. We're still seeing inflation run above the target 2% rate set by the Fed, mandated to the Fed, and the government doesn't really seem to be stopping the spending. We're actually accelerating spending. Ray Dalio comes out and talks about this. This is like the end of an empire when the people in charge just don't care anymore. They're just going to spend all the money with no regard. There's zero accountability. And look, I'm not blaming one party over the other. They both do this. This is not political, but this is what's showing up in the numbers. And we've had these falling mortgage rates down here on the blue line, and then we've had asset prices for real estate specifically just skyrocket. Well, when things change, as we know, we can see from a peak to the bottom, and it takes years for real estate to correct. It could be another massive 30% swing over the next decade or so. This stuff does not happen overnight. There's also a lot of reasons why this is different from the great financial crisis, but a lot of reasons why this is even worse than the great financial crisis in some ways as well. And this is what's happening in the marketplace without the massive job loss and still a very low unemployment rate. So the Fed is starting to switch kind of directions on how they think about the market, right? So inflation is higher than they expected. This comes through almost every single report. We don't even know which reports to believe anymore, and has been for years. So the Fed has not raised rates high enough to the point where they're getting inflation under control. And obviously, after we've had such a large amount of inflation in such a short period of time, even a 2% increase in inflation feels like a lot because prices are so elevated. Fed officials who voted to hike rates say action is needed now against inflation. And this comes with a new Fed chair coming in, which they kept rates the same at their last meeting, but it's now expected by some that we may even see the Fed raise rates even higher, which would put more pressure on housing because there'd be less buyers who can afford to buy at today's rates. The future market is now pricing in some cases, 1.5 rate hikes by the year end. We will see if that was to happen. That would destroy the housing market. The market is already so fragile with the marginal buyer being completely priced out. Here in Florida, we're just surviving off of people relocating here because the locals that haven't bought yet are completely priced out because the median income for a family here is $68,000, and what you need to buy a median price home here is between $100,000 and $115,000. So it's a massive disconnect between wages and the price of these assets. In raising rates would make that even worse. Obviously, it's not a direct implication of what will happen to mortgage rates, but they do generally move in alignment and are influenced by each other. And of course, when there's higher mortgage rates, lenders get crushed. And when you actually have a servicer built into the lender, a lot of times servicing is totally fine, which means they're collecting the payments from their borrowers. But when things get tough and people start defaulting, the servicer actually has to go to work to go find and collect those payments, especially in judicial states. It's more complicated. And what we've seen is this massive sell-off, like almost 90%, 83% in the last 5 years of UWM, the top U.S. mortgage lender, has plunged the most ever after pausing its dividend. They even needed to get a cash infusion. So mortgage lenders that have been consolidating, and even same thing we see in the real estate brokerage space, Real acquiring Remax, like all these acquisitions, Compass and Anywhere, all of these people are just gobbling up as much as humanly possible to consolidate because they have very high debt levels, their cash flow is dwindling, and they're looking to basically survive until the next market cycle. And we're going to likely see a lot more of that coming through, but the mortgage side does not look good, and so that's an indicator. And of course, because prices have had such a rapid increase, look at this. I mean, we got here in Florida more than 50% increase in a short period of time in just a couple of years. We basically had 10 years, 15 years of price growth within 3 to 4 years. And now nationally, we're starting to see, this is Freddie Mac US House Price Index year over year nationally, we're starting to see prices go negative for the first time since basically 2012, and that's without the distressed backlog of banks having to sell their properties, put their properties for foreclosure auction. And so we think that this is going to be a downturn that's going to play going into the end of the year. We could see housing prices nationally, even with the Northeast still doing just fine, we could see it go negative. And I know a lot of people say that's not possible, but I absolutely could see it because we're starting to see the pending home sales really slow down, and we're seeing closed sales also slow down. And look, this is what's happening right now because the number of buyers is really slow because of affordability issues. We're also seeing sellers then have their inventory stack and they're motivated to sell, and then they go ahead and try to cut their price as fast as possible to make sure that they're the next sale in their community. We see this especially being an issue in new construction communities. So look, it's spreading. You can see this is a national motivated sellers. This comes out from Parcel Radar, and you could just see that this red is starting to spread now. Just wait until November and December. Seasonality for real estate is extremely real. School is starting this week for many people, and when people go back to school, they're not out there looking to buy real estate anymore. A lot of people buy to try to get into the right school district. And so this will be a story to watch, is how many sellers are actively cutting their price every single month. And not only are they cutting prices, but it's taking longer to go under contract. You can see this is the median days to go pending in 2022. A lot of it's blue. It's like almost immediate, right? In 2021, 2022, houses were selling same day, cash offers, no inspection contingency. Now it's the exact opposite. And you can see it's the areas of the Sun Belt that are struggling the most over here. And you can see that those areas that went up the most are now the ones that are going down the most. They're taking longer to sell. The prices are coming down. Rents are coming down. And it's influencing that national number that we're seeing. And meanwhile, you're seeing in the Northeast, median price pending days depending are still going pretty quickly. But I can tell you, my people that I know up in the Northeast are starting to see the impacts of this higher interest rate show up in the market. So it has taken years for the Fed raising rates for it to really impact the housing market and slow it. And now we're at a point where we do think that the market will continue to slow moving forward now that these affordability pressures are really baked in to the market. And of course, the next story that I think is really going to impact the housing market is rents. Tenants are frustrated. There's an oversupply in the Sun Belt. There's apartments bidding basically for good tenants to come into their apartment buildings so they can get their financing straight. Apartment List says asking rent growth is down 1.1% year over year. A lot of the underwriters, when you do commercial apartments, they look for 3 to 4% growth in apartment rents. And so this going down is really going to impact their underwriting of the property, their ability to get financing. And if we see migration trends continue to change from coming to the Sunbelt areas and go actually out to the Midwest, it could really slow the demand and make things even worse. We could see rents come down even further from here. In Jacksonville, there's areas around town that have already dropped 10 to 20% in their asking rents. This hasn't showed up in the headlines. It's mostly around these new construction communities, but it's crazy. The builders continue to build multifamily, and they continue to build these entire communities at price points that the general population just simply cannot afford. And so we're going to have to watch this very closely to see why this is happening, why the builders have so much confidence. But the numbers and the migration patterns and the affordability constraints from the local population just simply don't make sense. So I don't know how they're making these numbers pencil. If you know, let me know. I'd love to learn. But I see these people start new projects every single day, and it's mind-boggling. Unless they're just choosing to use cash and they don't see another good place to put their money. But even then, with rents coming down, it just seems like a long-term bet at the peak of the market, which doesn't really make a lot of sense. Employment report is a huge one. You need wages to keep up. You need employment to keep up for the housing market to be strong. Wages is one of the number one determinant of the housing market. And the employment report that just came out was really bad. The U.S. economy actually unexpectedly lost 23 jobs in July. But even worse was that the numbers for the revisions were massive, and so they were overstating all of the employment stuff. And what's funny is when there's bad U.S. economy job numbers, what happens is the Fed is more likely to cut rates, so the stock market moves up on bad news because they think that this is more reason to cut rates versus raise rates. So we'll have to see how the Fed is going to play this out, if they're going to pick inflation over employment. But at this point in the market cycle, because prices are just so freaking high right now, I think that the Fed should honestly be hiking rates at this point in the market cycle and get the inflation under control. We're just going to have to get the pricing back to some normalized level. And if it's unsustainable, Stein's law, if it's unsustainable, at a certain point, it will break. We just don't know when that time frame will be. And the wage growth that we're seeing is also stalling out, right? So we had this labor shortages that made the wages go up 7.7% from 2021 to 2022, which is incredible. And now we're seeing the Fed, once they raise rates in 2022, you see in the shortages kind of dissipated. We actually saw wage growth now move all the way down to 20% below the normal rate. And this is the huge story that is not talked about enough. The consumer is maxed out financially. The wage growth is still moving up, but it's slowing. It's below the 60-year average. And we want people to be paid more so they can afford more, they can live in a house. But ultimately, this is going to impact the affordability story that is already drowning the U.S. Middle class. And it's no surprise when you look at all this together that the consumer sentiment for the United States, according to the University of Michigan Consumer Sentiment Report, is at a 74-year low. Okay, this is worse than all of the crises that we've had before. The administration doesn't seem to care. They talk about affordability crisis as a myth. It's not a real thing. It's a very real thing to the bottom 90% of Americans that are 68% of them are living paycheck to paycheck. And even this conversation when I dropped off my kids at daycare this morning, they were like, gas prices are so high, you need to cut back. And I overheard the conversation. So, I mean, this stuff it's real to people. People are experiencing it every single day. Love to hear from what you see out there. Are things getting better in terms of pricing, or are things getting worse for you? Drop down in the comments. But the consumer is completely maxed out. So wages are growing, but at a lesser rate. The consumer is having a more debt on their balance sheet between student loans, which is massive, credit cards, auto loans, other buy now, pay later loans that are growing. Almost every single debt class is rising. And so we're in a consumer debt crisis and a national government debt crisis at the same exact time. And the government has said that they're going to try to grow their way out of this, which is why the bond market is pushing interest rates higher, because that just means they're not taking the debts seriously when we should be cutting our budget deficits and focused on the debt and balancing the budget deficit, we're just doing the exact opposite, and we're just spending like drunken sailors again. I think this will catch up with us at some point. It's impossible to know when the bond market will react, but at some point the bond market will break and just say enough is enough. And at that point, it'll probably get Congress's and the administration's attention when it breaks. And when it breaks, it's going to be a very painful experience for everybody, because I think it's going to really stall the growth of the economy all at once versus taking it seriously now and trying to actually resolve it. I think it's more likely that a crash scenario is possible versus trying to address it now and be responsible. So I don't know how this is going to play out, but all I can say is that this is completely unsustainable from the government perspective and the consumer's perspective. And every single time that the government tries to outgrow their debt load, it creates massive inflation. And so think about that as an investor, a buyer or seller, where you want to play the game if you're expecting inflation down the line, if the administration continues with this rhetoric and the direction that they're going with the debt. And so here's what we're seeing right now in terms of the debt levels of the consumer. You can see that U.S. mortgage lenders are approving higher debt to income ratios than 2007. So we're seeing more and more people get these high debt to income ratio loans all the way up to 45% I'm seeing, which means that 45% of their income is going to their debt payments, which is absolutely absurd. There's really not much left over when you consider living expenses and taxes in that type of regard. And this is on the new mortgage origination. So there's these folks who are buying at the peak of the market with high debt levels. Those are the people who are going to be most at risk. It's not going to be the people who moved here from the Northeast and bought cash. They don't care what happens to the market because they're usually the top 10% of households. It doesn't matter. It's the bottom 90% that's loaded up with debt where the distress is going to be. And one of the things we did with our internal research, movewithmomentum.com, go check it out. We have the best data on the housing market for Florida, and we're expanding to other markets right now. But low down payment homes are now 33% of loans originated at these peak prices. You can see FHA is coming back, you can see VA is coming back up, and cash is coming down, and conventional is coming down. So more and more people are getting these loans, and it hasn't been this high really since right before the great financial crisis. And this is an indicator that the consumer's maxed out. We're scraping the bottom of the barrel for the buyers right now. And the low down payment loans, I think, would probably continue to move up from here, because that's just like the rest of the people who can actually buy. Because there's studies out there that show that the people who could have purchased, 80% of them already did and locked in those low rates. So now you're dealing with like the remaining 20% of people who are kind of on the margin that are buying, and they're using these down payment loans, these low down payment loans, and they're doing it a lot of times in new construction communities where if they have a job loss or they have to move in 2 to 3 years, they are completely stuck in underwater. And I'm seeing this every single day on the ground. I feel horrible for these people, but it is a real thing that's moving forward. And obviously in 2021, we saw a cash spike. So I think that's one story here too. These are all the relocations that were happening, people selling their house and then buying it cash. And the rest of it after that happened was the FHA jumping up. And look, this is the headline numbers, right? We had record low levels of basically foreclosures for the last few years. Why? Because we had these workout programs where if you didn't pay your house, you could lump it into the back end of the mortgage. This does not mean that the market is healthy. It actually is hiding the distress. And now that program changed October 2025, and we're starting to see the foreclosure filings start to move up very rapidly. And we expect the foreclosures to continue, especially here in Florida, because the distress is starting to pile up with the consumer. You're starting to see a little bit more job loss. You're seeing a little bit more shakiness in the market. And you're seeing these programs that basically were extend and pretend programs become more difficult to jump through the hoops. They couldn't extend and pretend forever. And so we have 5 years of backlog of foreclosure filings that will be playing out over the next 12 months. So I think pay attention to the foreclosure rate numbers. You will see those continue to move up because these programs are more difficult to work through. I think this is important to understand too. When you buy is super important. So not all vintage years are in a deep amount of stress. Like if you bought before the zero interest rate policy, that's ZIRP, zero interest rate policy, and you're probably fine, right? Because your house went up 30 to 40%. You've got a low rate, so your payment is affordable. But those people who bought after or at the tail end of 2021, 2022, when the Fed started raising rates in March of 2022, those are the vintage year that are going to have the most amount of pain because they're buying at peak prices with low down payments. And I think that's what, look, there's some vintage years that are better positioned than others. Obviously, this makes sense. Like when you buy too high at the end of the market cycle, those are the group of people who are going to get hurt the most. And so that's what we're seeing. So 73% of the closed debt in 2025 and 2026 was originated during those peak years. This absolutely lines up. So the distress isn't everywhere. It's going to be in pockets around new construction. It's going to be pockets around the vintage year, but there will be distress that shows up in the marketplace. So I'd love to hear from you. What do you think will happen with interest rates this year? What will it look like over the next 6 months? Our projection is that the number of transactions will continue to fall going into the end of the year. We're going to see inventory creep up every single month. And then it really depends. Obviously, midterm elections is going to cause some jitters, so people are going to put things on pause. And we really won't be able to tell how the market's doing until March of next year, because we're going to have seasonality take a hit to the market. And then March next year, when busy season picks back up, we're going to have to test and see how much it actually does pick up and how much it does fall off during these winter months. As always, if you need a top real estate agent in your market, feel free to reach out to me. I'm happy to be a resource for you. I respond to every email that comes through, john@movewithmomentum.com. Appreciate you guys. If you need anything, you have any questions, drop down in the comments. I look forward to getting back to all y'all. Thanks so much for watching.